Hi friends, when it comes to living a life of dreams, whether it's retirement with peace or whether it comes to your teenage wherein you want to spend a life of freedom or spend a life of choice so that you can earn additional income, we all want it, but you don't want to engage a financial planner or want to understand financial planning. So in this specific video, I'm going to make it short and sweet, wherein you understand the stages of financial planning, wherein you can do it for yourself. Or if you're interested in a detailed financial planning, you can drop a note and I'm glad to help you out. So share it to as many friends and colleagues as possible so that they can help themselves to do the financial planning in their own lives. So what is the first stage of financial planning? The first stage of financial planning, which I call as a quantifiable stage, is to identify your cash flow. And to identify cash flow, you need to make a list of all your active income, all your passive income. Active income could be your job or part-time job, and passive income could be like dividends, rentals, or it could be sale from assets. It could be anything. You can list it all down. When you have passive assets, it could be realized gains, it could be unrealized gains. So you need to put down only the realized gains, whatever cash flow comes into your pocket. And then when it comes to the expenses, which is also part of the cash flow, to identify cash flow, you need to deduct expenses from the income. So you need to identify all the expenses for the month or for the year, whichever is comfortable. You need to identify fixed expenses, variable expenses, debt related expenses, or your investment related expenses, slightly keeping aside. And then once you have done these two aspects, you keep it at one place, computer or on a sheet of paper. And then we go to the next stage, which is again the quantifiable stage, wherein you identify your net worth. And how do you identify your net worth? Is by doing your own personal balance sheet. So for a balance sheet, there are two parts. The first part is your asset, and assets are something which puts money into your pocket, and liability is the second part, wherein it takes money out of your pocket. So it could be a long-term liability or a long-term asset, or a short-term asset or a short-term liability. So when I say short-term, it is a year or less, and if it is long-term, it is more than a year. So you can give it the maturing period. So for example, if you have assets like policy premiums, you can write the maturing age for each policy premium. And if you have like property, of course, the age is long enough, so it can give you some, you can give it some identifier. And the reason why you're doing all this is because you can measure the ROI at a later point of time for those assets. Is worthwhile, or is it worthwhile to keep those assets or not, we come to a later point. So this is the second stage you need to do by identifying a balance sheet. The third stage, what you need to do is identify the qualitative measures. You need to do your own individual profiling, mindset profiling. When I say mindset profiling, it comes to whether you're an aggressive investor, conservative investor, moderate investor, and what's your investment style. Is it growth oriented, value oriented, contrarian style, or is it market capitalization based? So based on this understanding, and also about other parameters with respect to whether you're in a government job which gives you stability, or in a private job which gives you instability to some extent, and whether what is your current lifestyle, you can note down some indicative measures of what are the lifestyle all about, and probably what are the lifestyle you desire to achieve. So this is the third aspect which you need to do when it comes to qualifiable measures. And the fourth aspect which you need to then do is, once you get all these inputs, you need to do the analysis of all this data. That means from the cash flow, you deduct expense from the income, that is the cash flow. It may be positive, it might be neck to neck zero, or it can be negative. And then you also do your net worth calculation, wherein you deduct liabilities from assets to then give you your net worth. It can be again positive, zero, or negative. So depending on this, you analyze this information. So you analyze whether you're getting cash into your pockets at the end of the month, at the end of the year. Are you going to be net worth positive or negative? So accordingly, based on your situation, based on this analysis, you can either curtail your investments, curtail your expenses, or you could improve or increase your income by identifying other areas of income or investment which give you more income, or you could also improve your asset situation, wherein you can invest into certain other assets, so you can improve your asset situation, or capital assets or physical assets when it comes to property. It could also help you determining on whether if it is a negative cash flow but your asset or net worth is positive side, then it can help us determine whether you can do a lump sum investment today, or whether should you go for a SIP based mode of investment. So all these aspects come as part of the analysis, and this analysis then finally boil down to developing a plan, a strategy of your investment. So it will help you determine based on your financial goals. It will help you do the budgeting. So by doing budgeting, then you identify, because you have some certain goals, you need to have the budget to achieve those goals, right? So to achieve those goals, you need to balance out or synchronize your expenses so that you meet the budget to meet those financial goals. So this aspect of developing a plan then helps you do the budgeting, and also then helps you investing into those instruments which help you meet the financial goal depending on the expected rate of return. So that's the fifth stage of financial planning. And final stage, which is the sixth stage, is a review process or ongoing process to monitor this plan, to monitor this implementation and execution of this particular plan which we have developed as part of the fifth stage. You need to continuously feed back into the cash flow and the balance sheet to then see what is the residual improvement in the cash flow or the net worth, to then help you further invest to build wealth. And of course, the whole reason of building wealth is to achieve your financial goals, whether it comes to retirement or living a life of your dreams when you're still young, so that you can pay for your expenses whenever a recession comes, you're able to dodge the recession. So hope you have enjoyed this video, and please give it a thumbs up in case you have liked it. See you. Bye.